dear students. I am Dr. Simi Khurana from Ajay Kumar Garg Institute of Management, Ghaziabad. Today I am going to discuss Unit 2 of Financial Derivative, and my topic is currency future, in which I will discuss the feature and the importance of the currency futures. Meaning of currency future contracts. Currency future contracts are just like similar to the future contract, only the difference is the change in the underlying asset. Here the underlying asset is currency. Again there are the two parties, one is buyer and the seller. If you are going to buy the currency, it means you have taken the long position, and if you are going to sell the currency, it means you have taken the short position. It depends upon the situation whether you are going to buy the currency or you are going to sell the currency. It is a standardized contract, it is traded on the exchange, the quantity is specified, the future date is defined, the price is decided in the advance. Both the buyers and the sellers have given a right, either they can buy or the sell underlying currency. A currency future contracts provides simultaneously right and obligation to buy or sell a particular currency at a specified future date and a specified price, a standard quantity. Currency future contracts are actually started in the year 1972 at the International Monetary Money Market, which is the division of the Chicago Mercantile Exchange at Chicago. And the major currencies which at this exchange were launched were, it's a British pound, Canadian dollar, French francs and Japanese yen. Now let us discuss about the silent features of the currency future contract. The first one is the organized exchange. It is not OTC market. Over the counter market is not there. It is an organized exchange where the currency future contracts are traded. Then standardization. Standardization means each and everything is defined there. Amount of the asset is given, expiry date is given, delivery date, deliverable grades are given, and each and everything is given there. That is why it is come under the category of the standardization. Then clearing house. Clearing house plays a very important role in the case of the currency future contract, any future contract. It is not only the currency future contract. Whenever the person take a position, whether it is a short position or it is a long position, the buyer has to deposit some amount which is known as a performance bond in the with the clearing house as a security, so that they can eliminate the credit risk and a party to all the contract, and this is known as a performance bond also. They have deposited some amount with the clearing house. Then daily mark to mark and the system of the margin. It means that whenever there is a profit or it is a loss in the market, both are going to be settled daily in the initial margin. Then actual delivery is very rare in the case of the currency future market. The next feature of the currency future market is a contract specification, and all the things are defined here. The contract size is defined, method of stating exchange rates are defined, maturity date is defined, last trading day is defined, and we have already discussed the collateral and the maintenance margin, which we will discuss in detail in the next slide. Settlement commission is there. The commission is taken by the bank in which you have opened the demat account. Then use of the clearing house as the counterparty. There is no risk of the counterparty in the case of the currency future contracts. They are the four actuality में global future exchange. This one is the international monetary market, then the London International Financial Future Exchange, CBOT, Chicago Board of Trade, then Singapore International Monetary Exchange, Hong Kong Future Exchange. The next feature of the currency future market is the minimum variation. It is also known as a tick size. There is a minimum change in the prices, price variation in different currency. Minimum price variation is also called a tick size, which is standardized for every contract, and it is vary from exchange to exchange, and generally it is 0.01% or $0.001% of a currency. As I have already told you that the clearing house plays a very important role in the currency future market. Whenever the importer or the exporter take a certain position in the market, they have to deposit certain amount with the clearing house, that is also known as a performance bond in the form of the margin. It must be deposited with the clearing house, and it is treated as a security against each party's market position, and we can discuss one by one the different types of the margins. The first one is the initial margin. When the importer, exporter or the banker or the multinational corporation has taken a position, they have to deposit the certain amount with the clearing house. It is a percentage of total amount. It may be 2%, 3%, which is vary from one currency to another currency, and it may vary from one exchange to another exchange. It comes under the category of the initial margin. Then variation margin. Variation margins means your initial margin is going to be adjusted. It is going to be added if it is a profit, it is going to be deducted if there is a loss. It means day to day transactions are adjusted in the case of the variation margin, and your margin is going to be is not remain the same as an initial margin. Then maintenance margin. Actually, you have to maintain a minimum balance in their account. If any amount, if there is any margin account, if the balance falls below this, margin call is issued. If not met, position is liquidity. It means uh, the call is given to the person. It may be the importer, exporter or any kind of the person, speculator, trader or the hedger, import, they have given a call. If they are not going to deposit the amount when the call is given to them, then their position is going to be scare off. Scare off means their position is going to be closed. It is we can say in another word, it is going to be liquidated. Margin can be deposited in cash or specified securities such as a tertiary bills. Level of margin may be changed if there is a volatility increase or decrease. It may be less, it may be more, it depends upon the certain situations. Now the currency futures in India. It was started on August 8, 2000, on August 29, 2008 at National Stock Exchange, and later on with a couple of months it was started in the Bombay Stock Exchange and Multi Commodity Exchange. Uh, there are certain features. The first one is the contract will be the cash settled in the Indian rupee. Then the contract will be always expire on the last working day of the month, and the quotation will be given in the rupee terms only. It is a very important that the quotation will be given in the rupee terms only. Unlike OTC, over the counter forward contracts, no underlying exposure is required to trade in the US dollar and Indian futures. Individuals can also be traded for purely speculative purpose. Actually, importers and the exporters or the bankers, they are going to trade only when they want to hedge their risk, but the individuals can take a long or the short position depending upon the situation of the market for the speculation purpose. Speculation purpose means they just want to earn a profit. It does not mean that they are not facing the losses may be there, but their main motive is to earn a profit, and the margin will be calculated by using a VAR framework. Major participant: bankers, importers, exporters, then multinational corporations, speculators, hedgers, traders, then even the foreign institutional investors and the non-resident Indians can also allow to trade in the currency future. I will explain this with the help of an example how the importer or the exporter use the currency future for hedging their risks. Let us take Mr. Ram imports the goods worth rupees 1 1 lakh 1 lakh, or we can say it is a quantity of 1 lakh unit, 1 lakh unit. When the Ram imports the good at that time, $1 is equals to rupees 70. It means at the time is after 3 months. Now he is going to import the goods that is of 1 lakh quantity. How much amount he has to be paid? 1 lakh multiplied by 70, that is rupees 70 lakh. This much amount he has to be paid to the person, to the company. You can name it as a XYZ company. Now there is a change in the currency rates. There is a fluctuation in the currency rates. The dollar may be increased to rupees 80. It may decrease to rupees 60. If it is increased, then there is a loss, and if there is decrease, then there is a profit to the importer. For this purpose, he has taken a position. He has taken the long position. Long position means Mr. Ram buys the currency future. Buy currency future. Let us take at the time of the contract, the currency future is decided at $60. Expiry date dollar is rupees 70. In the previous slides, I have shown that he buys 1 lakh units at rupees 60. It means how much amount he has to be paid? He has to pay rupees 60 lakh. and at the time of the expiry, and he has taken the long position at the time of expiry, it is traded on rupees 70. It means 70 lakh. Now there is a profit of 10 lakh to the importer and he easily managed this situation. But if the reverse is going to be happened, in the case of 70, it will become 50. Then what is going to be happen? It is the loss to the importer. How much loss? Again it is a loss of rupees 10 lakh. And it is a very big loss. That is why the importers or the exporters are going to hedge their risk with the help of the currency future contract. In another term, we can say that there are the other situations also. He will not buy the currency future contract, he will not do the trading. Then how much amount he has to pay? He has to pay the whole amount, means he has to suffer the loss. Now the next one, what are the important uses of the currency future? The first one is the currency future provide a protection against the exchange rate fluctuation. I have already told you that, my dear student, there may be the fluctuation in the exchange rate, it may be increase or decrease. If it is increased, then there is a loss to the importer, but there is a gain to the exporter, but the reverse is going to be happen in the case of the exporter. If we are going to import the good and the prices are going to be increased, then the importer has to pay the more amount as compared to the earlier. But in the case of exporter, they will gain the things. For this purpose, we are going to use the currency future contract to hedge their risk. They facilitate the importer and exporter. I have already told you that to fix the prices for the foreign currency and hedge the risk accordingly. They initiate the investor to take the advantage of the fluctuation. Advantage to the fluctuation means the individuals are also going to enter into the contract. It does not mean that the importer, exporter or the multinational corporations are going to take the currency future contract. It can be done through the individuals also, but the main aim of the individual is to earn a profit. It is come under the category of the speculation. It does not mean that they are not losing the money, they can lose the money if the reverse is going to be happen. In the foreign exchange and take a position in the market in the future. They assist the individual investor to trade over and above their foreign allocation. They are safe and secured in the comparison to the OTC. OTC trade means over the counter trade, you know very well, my dears. They are the customized trade, they are settled according to the needs of the buyer and the seller of the contract. But the currency future contracts are those contracts which are traded on the exchange, and these are standardized, these are transparent, these are very safe as compared to the OTC contracts. Now the next one is they are highly liquid instrument because they can be easily transferable and sold any time before the maturity. As we know that each and every currency future contracts are settled on the last working day of the month. In the case of the future simple future contract, they are settled on the last Thursday of the every month, but in the case of the currency future contracts, they are settled on the last working day of the month. And suppose if you are a trader, then even you are a trader and you want to earn a profit only. It is not mandatory to you to hold the position up to the end of the month. You can easily take a position, you can easily liquidate the position, you can easily square off the position if you are getting a profit in the currency future contract, and it can be easily transferable, it can be easily sell out within a second. You can buy the future contract or within the sell you can sell the currency future contract. If there is a profit and you do not want to take more profit, you can easily square off your future contract. currency future contract. These contracts are subject to the margin limits and investors have to make the adjustments of their margin daily. I have already told you that there are the different kinds of the margins, that is the initial margin, maintenance margin, variation margin, and in the first you have to deposit the certain amount with the clearing house, and then your profit and the loss is going to be added in your initial margin. If it is a loss, it is going to be deducted. If there is a profit, it is going to be added. In the case of the maintenance margin, you have to maintain your balance account. If it is fall below the certain amount, then the call is given to the importer and the exporter, and they have to do the they have to deposit the amount to the clearing house. If they will not do that thing, then their account is going to be liquidated. Then they eliminate the counterparty risk, and these are more transparent, efficient and accessible to the OTC currency future contracts. Then the next one is they are executed on the price time purity, ensuring that the best price is available on each underlying currency. In the future contract, we have already discussed this thing. The profit or the losses are also paid, which are collected on the daily basis. Then the scope of accumulation of the losses get limited for the traders in the case of the currency future contract. It does not mean that they are not facing the losses, there are losses, but the losses can be minimized, the losses can be less if they will take a position, if the importer and exporter will take a position, then if they can hedge their position, then the losses can be minimized. Otherwise, they have to bear the lot of the losses if they are not going for the currency future, because there is a great fluctuation in the exchange rate. It may be increase or it may be decrease with a certain period of time within a Thank you, my dear students. Today we have discussed about the currency future, their features and the different uses of the currency future contracts. In the next topic, I will discuss the hedging and arbitration with the currency future contracts. Thank you. Thanks a lot.